The Chinese stock market will outperform all American stocks in 2023. We've just had some really interesting data come out with the performance of the Hang Seng index over the past 4 months, which, by the way, is up almost 50%, with none of the Western media covering it to a big extent. This, in my opinion, goes to show exactly why Chinese investors were so criticized and why, now that the market is rallying, there is very little coverage of the recovery and growth that is going on in the world's second largest economy. And to be honest, I'm not surprised by this. The Western media's job throughout this entire Chinese bear market has been to bash Chinese companies, even though their fundamentals are strong and the valuations came down to ridiculous levels. Alibaba stock, for example, is up almost 100% since its bottom in October, yet nobody is discussing how this happened and what this means for not only Chinese stocks, but also how American stocks can bottom as well. And this phenomenon is exactly what I want to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Now, to start things off, for those that haven't been keeping up with what's been going on in the Chinese stock market, essentially the market bottomed back in October when everybody expected Chinese stocks to continue to fall. You had retail investors panic selling. You had fund managers from Morgan Stanley, JP Morgan, reducing their allocations to Chinese equities in Hong Kong drastically in the fall of 2022. But as you can see, that was clearly a wrong decision. I myself am an investor in the Chinese stock market. I own a stock by the name of XPEV Motors, and I also own shares in Alibaba. Believe it or not, over the past 12 months, this Hang Seng index is officially outperforming the S&P 500 here in the US. Yes, both of these indices have been in a downtrend, but because of the sheer destruction Chinese investors saw, the returns they're going to see to the upside is going to be higher than those in America. This is a big reason why I had a percentage of my portfolio allocated to Chinese equities. Yes, I don't live in China. Yes, I have no clue how Chinese businesses on ground zero are doing. But I had connections in China. I invest in companies that do business in China, and I could really easily filter through all the BS the Western media was pushing through when it comes to the state of the Chinese economy. COVID-0 was supposed to be this destruction of the Chinese growth story, and the Xi Jinping empire was supposed to be the end of capitalism in China. But smart investors are now realizing all of that was just a frenzy to panic sell retail investors and to allow institutional investors to flood in their positions. Because now they realize the American stock market might actually struggle longer than most other emerging markets because America is actually struggling with significant inflation, which results in higher interest rates. The bond market has been destroyed in America, and so now the only way to actually get a growth-focused portfolio with little uncertainty is Chinese equities or the Indian stock market. As a matter of fact, Alibaba, Tencent, which are the biggest technology firms in China that are publicly traded in the US, were actually cheaper than electric utility companies in the S&P 500. The reason why this is crazy is because utility companies always have extremely cheap PE ratios. And there's obviously a very important reason for that. Utilities don't grow that much. They don't grow revenues and they don't grow their earnings that much year over year, meaning their valuations are naturally cheaper compared to the other sectors of the S&P 500 like technology or healthcare. There's obviously very high capital expenditure that is also required for utilities, which deserve a lower PE as a result. But as you can see, some of the most innovative companies, high margin software businesses that are ingrained in the Chinese economy, like Alibaba and Tencent, since the start of 2022 were trading lower than the PE of the utilities of the S&P 500. This shows you the discrimination that was going on in equity valuations, and any investor who understands the stock market is a forward-looking indicator would understand that this is an investment opportunity of a lifetime. And particularly, I think this is going to play hands very well in the Chinese EV space. Chinese stocks like XPEV Motors, NIO, and even Li Auto have actually been lagging the rally we've seen in the Hang Seng index. And this is mostly because Chinese EV stocks are considered the riskiest form of Chinese stocks here in America. Alibaba, Tencent, and Meituan are profitable companies that are growing earnings, but obviously Chinese companies in the EV space are very early stage and they're investing really heavily in growth. But because of China's insane growth expectations of almost 5.7% for 2023, there's a big chance that the Chinese auto market will recover just as fast as the overall economy is. High-frequency data from ground zero in the form of intercity mobility, subway, and passenger volume show us that recovery from the COVID fallout has rebounded extremely aggressively in China. Hong Kong stocks are showing us this leading trend in the Chinese economy, which even though on a lagging basis in the form of earnings, revenues, and gross margins for Chinese companies is going to be bad, if you're a long-term investor focused on the next 18 to 24 months, this is a great sign. Because even with the rally in the market right now, some companies in China are trading cheaper than what they would if the economy in China was at a standstill. What tends to happen in a stock market bottom is that the overall index bottoms first, and then the riskiest assets follow suit. Some companies might not survive, but those companies with good fundamentals and valuations in the form of price-to-sales ratios that were compressed significantly will start to all of a sudden expand. And that's what we're seeing happening with stocks like XPEV Motors and NIO, which are obviously one of the only publicly traded EV stocks from China here in the US. And why exactly do I say that? Well, if you look at the valuation of Alibaba, it got destroyed from a PE and PS ratio since the start of 2021. The reason why this trend is down is because the company is growing and their growth is slowing, meaning they deserve a slower PE. But what's happened now over the past 4 months as the overall market has rallied is Alibaba's PS has gone from 1.82 to 2.66. That is a 50% growth just in price to sales. That doesn't even account for the PE ratio growth that Alibaba has seen over the past 1 year. This has gone up more than 150%. Now, obviously, a big reason for this is Alibaba's earnings have gone down. But it is still nonetheless a good metric for us to judge the trend of where equity valuations might be going. And so now if you compare it to EV stocks like XPEV Motors, you can see that these guys' PS ratios have not ticked up just yet. They're still stuck in that downtrend that we've seen in the Chinese bear market. And obviously their PE ratios are going to continue to improve to the upside because they're getting less and less lossy each quarter. The more economies of scale they build, the more customer acquisition they have, the higher revenue they grow, they're going to have less R&D and SG&A expenses each quarter. So as this PE ratio starts to collapse and potentially starts turning positive in 2 years' time, and the price of sales starts ticking up, what do you think is going to happen to the valuation of these companies? And if you even just want to look at the broader index, forward earnings estimates for Hong Kong indices are going up over 50% over the past 4 months. This not only shows us that this rally that the market's seeing is not a fake rally, it also shows us that investors in the West now actually understand why Chinese economy is so important and how it's growing. If you see a 50% growth in earnings for companies, that means gross margins are expanding, and that likely means consumer spending is going to start going up as companies are able to target their customers and charge them higher prices. And that will naturally translate into potentially higher revenues into different parts of the economy. And right now, one of those big parts of the economy is going to be the Chinese automotive sector, which is dominated by electric vehicles. And no, the Chinese government does not want to kill its economy. Unlike what many people were thinking, the end of capitalism is nowhere near what the Chinese economy is actually going into. The economic czar Liu He of China just vowed that he's going to actually support private businesses by giving them grants, lower interest rates, and actually spur economic growth in China. Because he understands that the technological race is not over. Russia, US, and Europe are fighting for not only the clean energy race, but also the AI race. And if China wants to win, they have to support their own businesses, particularly their private businesses, because China's public business domain has very little credibility. And they have very little exposure to foreign businesses, which is what they need to do to be able to gain a competitive advantage. And funnily enough, Ryan Cohen, the famous investor of GameStop, is actually also buying stocks in Alibaba recently, which I found really interesting, even though I know he has lost a lot of his credibility over the past year, because it shows us that he's actually seeing a similar opportunity of discrimination in the valuation like he saw with GameStop in early 2019 and 2020. GameStop was trading at like $1 back then, and now it's trading, by the time that the market hit a peak in 2021, of almost $400 a share. And as for what exactly I'm going to do with my portfolio, I'm going to continue to follow my conviction and invest in Alibaba and XPEV Motors, which are my main two individual stock holdings in the Chinese sectors. And when it comes to ETFs and indices, I'm going to be buying the XPEV CSI China ETF, which has been one of my favorite plays to gain exposure in a more diversified way to the Chinese economy. This ETF is actually up almost 100% since the bottom that it hit in October. And yes, I have been an investor in this for almost a year and a half now, and it has suddenly been a difficult ride. But I've taken advantage of all the dips we've seen and been continuing to dollar cost average despite all the fear and FUD we saw in the media, and it seems like now my average cost basis is actually below what the price is trading at, which obviously is a great sign given the fact that this thing was trading all the way up to $97 a share back in early 2021. But as usual, guys, none of the things in this video are financial advice, so make sure to do your own research before making a decision about buying or selling anything. This is just my take on the discrimination we've seen in Chinese equities, so I hope you guys can relate, and let me know your thoughts down in the comment section below, because obviously this is just my opinion. But as usual, guys, thank you very much for watching, and I'll catch you guys in the next one. Take care.